Warren Buffett once bet $1 million that a single boring investment would beat the smartest hedge funds on Wall Street. He won easily, and what he picked is something you can buy in about 5 clicks. By the end of this video, you'll understand exactly what index funds are, why they beat most professionals, and how even $100 a month can change your life. Let's break it down. So what is an index fund? Imagine you walk into a pizza party, 20 different pizzas. Instead of guessing which one's best, you grab a small slice of every single one. If one's bad, doesn't matter. 20 others are great. That's an index fund. Instead of betting on one stock, you own a tiny piece of hundreds of companies all at once. Buy one share of an S&P 500 index fund, you instantly own a tiny piece of the 500 biggest companies in America. Apple, Google, Microsoft, Amazon, all of them. One purchase, 500 companies. The most popular ones you've probably heard of: VOO, which tracks the S&P 500 from Vanguard. SPY, the original, been around since 1993. And VTI, which gives you the entire U.S. stock market, not just the top 500. And here's the part that blew my mind when I first learned it. There are 4 simple reasons index funds just keep winning. Reason 1, diversification. Instead of betting on one horse, you're betting on the whole race. If Apple has a bad year, Microsoft might be crushing it. If energy stocks are down, tech stocks might be up. The basket carries you through the rough patches. Reason 2, they're stupid cheap. Most index funds charge you less than 0.1% per year. That's basically nothing. Active funds, where a fancy manager picks stocks for you, often charge a full 1%. Same goal, same market, but roughly 20 times the cost. Think of it this way. Same dish at 2 restaurants, but one charges you 20 times more. And that fee gap adds up. On a $100,000 portfolio over 30 years, that 1% difference could cost you over $120,000 just in fees. Reason 3, compounding. This is the magic ingredient. Your money earns returns, then those returns earn returns, then those returns earn returns. It's like a snowball rolling downhill, slow at first, then enormous. And index funds let compounding run for decades without fees eating it away. And reason 4 is it's truly set it and forget it. No checking your phone every hour, no stock picking, no anxiety at 3 a.m. Just buy consistently and go live your life. That's the whole strategy. But there's a trap most beginners fall into, and it can cost you everything. 2 mistakes that destroy beginners. Mistake 1, panic selling. The market drops 20%. Your stomach drops. You sell everything at the bottom. Then a year later, the market's at all-time highs without you. During COVID in 2020, the S&P 500 dropped 34% in about a month. People panicked and sold. Within 5 months, it had fully recovered. Those who sold locked in their losses forever. Mistake 2, trying to time the market, waiting for the perfect dip, the perfect moment. Spoiler, nobody knows when that is. Not you, not me, not even the pros. Research shows that if you missed just the 10 best days in the market over the last 20 years, your returns got cut in half. Time in the market beats timing the market every single time. Okay, so now you know the pitfalls. Here's the one number that makes it all real. $100 a month for 30 years. Let's run a simple example. You invest $100 a month into an S&P 500 index fund. Every month, rain or shine, for 30 years. The average annual return of the S&P 500 over long stretches has been roughly 10%. So you put in $100 a month, 12 months a year for 30 years. That's $36,000 out of your pocket total. But thanks to compounding, that $36,000 grows into roughly $226,000. You didn't pick stocks. You didn't time anything. You just showed up every month. And if you want real proof, look at VOO. This $10,000 invested in VOO about 15 years ago would be worth roughly $86,000 today. That's over 760% in total returns. Not from some genius stock pick, just from owning the 500 biggest American companies and being patient. Now, let me be very clear, there are risks. Index funds are not a savings account. They go down, sometimes a lot. In 2008, the S&P 500 fell over 50%. In 2022, it dropped about 25%. If you need this money in 2 years, an index fund is probably not the right place for it. These work best when you have a long time horizon, at least 10 years, ideally more. Also worth knowing, not all index funds are exactly the same. SPY has a slightly higher expense ratio than VOO or IVV. VTI gives you the whole U.S. market, including small companies. Fidelity's FXAIX has basically 0 fees. They're all great options. Just pick one that matches your brokerage and keep going. So here's your bottom line. You don't need to be smart. You don't need to watch financial news all day. You don't need a finance degree. You just need to stay consistent, and let time do the heavy lifting. Stay, let time work. That's the entire playbook for building wealth with index funds. That's it. That's the whole secret. Boring works. If this made index funds click for you, hit subscribe. We make investing simple every single week. And remember, this is not financial advice. It's for educational purposes only. Always do your own research, and thanks for watching. I'll see you in the next one.